When you're building your own portfolio, it's really useful to have some examples you can look at. These are off-the-shelf portfolios which have been back-tested based on historical returns. And in this video, I'll look at two in particular, and that's the Golden Butterfly and the Pinwheel portfolio. And I'll also show you exactly which measures to look at, not just measures for risk, but also measures for return, and also what happens after you retire. So if you do want to learn more about investing, then why not sign up to our free weekly market roundup? There'll be a link in the description below me and above me. So let's look at those two portfolios in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's begin by looking at the Golden Butterfly. The portfolio is a very simple one which consists of 1/5 of each of these different types of asset. And the golden bit comes from the fact that 1/5 of the portfolio is invested in gold. And when you plot it on a pie chart, it looks a little bit like a butterfly. There are two equity wings. One is the total stock market, and the other one is a factor fund, which is small cap value, which is a combination of small stocks which tend to outperform over the long term, but a subset of those small caps where the valuation of the stocks is low. Value's certainly been out of favor recently, but historically it's been a very good performer. And the combination of small cap and value has outperformed even more. Then on the fixed income side of the portfolio, we've got long-term US Treasuries and also short-term US Treasuries. And each of those assets has an equal weighting in the portfolio. And we'll be comparing that with the Pinwheel portfolio. In addition to the total stock market and small cap value, this also has international stocks and emerging market stocks. It also has real estate investment trusts and cash, which is equivalent to very short-term government bonds, and it has intermediate bonds. So no long-term bonds in this portfolio. Notice how the weights alternate between 15% and 10% all the way through. And that's why the pie chart of the allocations looks a little bit like a child's toy called a pinwheel. Now, when you invest your money in any financial asset, what you're actually buying is a return distribution. Now, here I am on June the 23rd, 2009, and right underneath me, you can see the value of this developed world equity fund, actually issued by Vanguard, was worth exactly 100. Then one day later, on June the 24th, the value of that fund went up by 0.2%. And that's why it says 0.2% above me. And if we actually look at the distribution of returns so far, we've only got one return. And what we're going to do is create a series of buckets in this second plot in the bottom panel. And what you can see on this x-axis here is the daily return, going from -10% on the far left up to +10% on the far right. And it's broken up into 1% buckets. Now, because this 0.2% return is slightly positive and between 0 and 1%, that's going to go into this 0 to 1 bucket, which now has a count of 1. And on June the 25th, the return above me now is 2.2%, a positive return which is larger than the first one we got. And that's going to go into the between 2% and 3% bucket, which is just beside me. Then on June the 26th, we got a return of -0.8%. It's our first negative return. And that goes into the -1% to 0% bucket. Now, if we fast forward for 10 days of returns, you can see that the distribution is starting to look a little bit like a bell shape, where most of the returns are close to 0. Sometimes you get big positive returns and sometimes you get big negative returns, but mostly the returns are small and clustered around 0. And if we have about 5 months of data, you can really start to see that bell shape start to emerge. It's not actually a normal distribution. The wings are a little bit wider and the middle bit is a little bit pointier. Or as statisticians like to say, it's a little bit leptokurtic. And if we now look at a decade's worth of daily returns, you can see that the counts become really smooth. And we're starting to see some of the detail in the upper tail and the lower tail here on the downside. Remember, this is where you make your losses, on this very long downside tail. And just a slight positive asymmetry is enough to give you this gentle drift upwards in the value of the index. And we can now compare different assets to see what kind of return distributions they tend to give us. In this left-hand panel, we've got developed world equity, which we saw before. And I've made the width of the buckets a little bit more narrow so you can see the finer structure in these daily returns. And you can now really make out these very large positive one-day returns of more than 5%, but also these very large negative returns in excess of 5%. But again, most of the time, you'll see the returns are clustered around 0. And if we compare the daily returns with UK investment grade corporate bonds, you can see that the return distribution is much more narrow, which means we have less uncertainty about the returns we get, but it's also the case that we generally get smaller returns for investment grade corporate bonds than we do for equity. So the average or mean return that we get for investment grade corporate bonds is just 2.7%, whereas the mean return for equity is 5.4%. And that makes a big difference over a long period of time. But another thing that these return distributions let us look at is how often the return is negative. And here the two assets are quite similar. The returns are negative about 44% of the time for the developed world equity, excluding the UK, and about 45% of the time for UK investment grade corporate bonds. And if we look at the width of the distribution, which is what those arrows signify, you can see that uncertainty characterized as a wider distribution. We're more uncertain about the exact level of return we're going to get for equity. And volatility is a very commonly used measure of risk. In statistical terms, it's called the standard deviation, which is 14.9% for equity, but only 5.4% for UK investment grade bonds. So what does the distribution of returns look like for the golden butterfly? Well, you can see in the distribution above me that the average return is 6.4%. And the standard deviation, or the volatility as we prefer to call it, is 7.9%, which is fairly low, much lower than for equity on its own. And the loss frequency, and remember this is annual data rather than daily, is just 18%. In other words, 1 year out of 5, you're going to get a negative return with this portfolio. If we compare that with a Pinwheel portfolio, well, the average return is a little bit higher, which we like because it means the upward drift will be slightly faster. But what we don't like is that the standard deviation, or the volatility or uncertainty of returns, is 10.9%, which is quite a bit higher than it is for the golden butterfly portfolio. And the probability of a loss in any given year is also higher at 26%, which is another unfavorable characteristic. Another question we can ask is, if we have a fixed level of investing every year, how long will it take to accumulate $1 million? In the case of the golden butterfly above me, what you can see is lots of green lines. Now each of those lines is starting off at a different year, starting from 1970, then starting from 1971, then 1972 and so on, looking at the period of time it took in order to build up $1 million, where you're contributing $10,000 every year. And of course, the bigger the returns that you get with the portfolio, the less time it takes to accrue $1 million. In the worst case, it took about 27 years, and in the best case, it took 21 years, when there was a stretch of very strong returns for the portfolio. And in the Pinwheel portfolio, the actual best and worst cases are very similar. 20 years is the best case, and 27 years was the worst case for building up that $1 million threshold. And one beautiful measure which the Portfolio Charts website has is called the Ulcer Index. Now the blue line in this graph is the level of the S&P 500 where dividends are reinvested, and I've also adjusted for the rate of inflation. And overall here you can see about 70 years of data on the graph. So you'll see I've had to use a logarithmic scale here on the y-axis. So what I've also done is to mark on these red lines that show the peak up to that point in time. And then we get these very frustrating periods when the value of the S&P falls below that peak and takes a long time to return to it. So this period here was about a decade, which spanned the end of the 70s and reached the mid-80s. And then we had another one of these lost decades just after the beginning of 2000, when the dot-com bubble burst. Then when equity markets were just about to recover, we got the global financial crisis, which knocked us down again, which meant that it took over 10 years to get back to where we were. So you can just imagine the frustration during these drawdown periods, as they're called. And that's what the Ulcer Index tries to measure. The definition of the Ulcer Index, which was co-created by Peter Martin, and which is described here on this tangotools.com website, is a number which measures not just the size of these drawdowns, but also the duration of those drawdowns, and how long the portfolio takes to recover to earlier highs, such that a deeper drawdown and a longer drawdown increases the number of ulcers. So the way it's shown here on the Portfolio Charts website is really neat. This horizontal line shows the deepest drawdown. In other words, the biggest peak to trough fall for the Golden Butterfly portfolio. And that was 11%, which isn't too bad. Bear in mind that for equity, you sometimes get falls of 50% or more. And the longest drawdown is the vertical line, which was a period of 2 years, which, although painful, is a lot better than those decade-long periods which we saw for the S&P 500. And this Ulcer Index really shows up the Pinwheel portfolio as being not as good as the Golden Butterfly, because the deepest drawdowns are much deeper. They go down to 26% versus the 11% with Golden Butterfly, and the longest one is very long indeed, at about 5 years, but still not as bad as equity alone. And combining those factors, we get an Ulcer Index of 6.3 for the Pinwheel and just 2.7 for the Golden Butterfly. We're always hearing that it's good to be a long-term investor. You'll almost certainly get more out of investment if that's your approach. So let's look at the long-term returns of these two portfolios. The way Portfolio Charts does this is to let you adjust the horizon over which you invest, and then look at those returns. So in this upper panel, you can see the value of $1 invested in the Golden Butterfly portfolio in 1969. It's gradually drifting upwards over time. And in this lower panel, you can see the rolling 2-year returns. What we mean by that is you invest $1 in 1969, you shut your eyes, and then 2 years later, you can see that you've got a return of just over 5%. Then in 1970, we do exactly the same thing. We invest $1, we shut our eyes, and 2 years later, we look to see what we've got, and this time we got a return of over 10%. But because this is a short investment period of just 2 years, we often get negative returns over this very short period, which is why we invest over a longer period of time usually. This is what the 5-year rolling periods look like. Notice that now the return is never negative. It's always positive for the Golden Butterfly. So now let's look at the 10-year periods. If we invest $1 in 1969 and then look to see what it's worth in 1979, the compound return over that period was pretty good at 6.4%. Then we'd roll 1 year forward and do the next 10-year period, and there the return was a bit better. So on Portfolio Charts, you can set the investing time frame, which is here 10 years, and you can see that the typical investment return over that period is 6.3%. The highest 10-year rolling period gave a return of 8.3%, and the worst period was 4.1%. But notice the return is never negative. And looking at the Pinwheel portfolio, you can see the typical return is a little bit higher at 6.8%. But you can see that sometimes it disappoints. So the minimum return here is 2.4%. But the upside was also a little bit higher at 9.8%. So by this measure, I'd say Pinwheel is a little bit ahead, but the downside tail is letting it down slightly. The last thing we'll compare are the safe withdrawal rates for the two portfolios. If we were to plot the value of most people's retirement savings over time, it would look a little bit like this. So let's say you start work at the age of 20 and you start saving into your pension. And very gradually over time you see the value of the savings build up. Now at that point you start to withdraw money from your savings. And the name of the game is that you don't want to outlive your money. So in this case the money only reaches zero after you die, which is a good thing. Because if your savings reach zero before you die, then you're going to be asking your family to support you, which nobody wants. Now, if we have the same level of savings when we retire, but now we're going to draw a larger income, you can see that the value of the portfolio depletes much more rapidly over time. And now you can see that the money's run out before we die, which is what we're trying to avoid. And another thing we can look at is what level of withdrawal never depletes our portfolio. In other words, the level of capital remains constant or even increases. So let's say that we retired in 1990 and we'd built up $1 million in our pension pot. And let's say that our living expenses are about $50,000 a year in 1990, which is 5% of our total savings. Well, once we take out that $50,000, we'll be left with $950,000 from our original million. Now, the investment returns of the Golden Butterfly portfolio were minus 8.6% in 1991. So the value of our $950,000 investment actually fell for that year. But we still need to survive, so we still need to withdraw at least $50,000. But because of inflation, we're going to need more than $50,000. In fact, we'll need another $1,500 in 1991. And because inflation is generally positive, we'll find that year on year, we're taking out more than $50,000. And that's going to leave us with $817,000. Then in 1992, the returns were very good. We got 15.6% with our portfolio, which is great. And that took the value of our portfolio back up to about $945,000. But oh no, our cost of living has increased again due to inflation. It's now over $53,000. So that's what Portfolio Charts is going to be doing in the graphs we're about to see. The actual withdrawal rate percentage is only for the first year in the period. The amount actually withdrawn in the following years will be increased by the rate of inflation. In fact, if we track that $50,000 over time, it increases very significantly over that 30-year period, such that by the end of the period, it's almost doubled to $100,000 a year. And that's why inflation is so important in retirement. If the rate of inflation gets out of control, it can have terrible consequences for retirees. If we look at the value of that $1 million pot, starting with that $50,000 withdrawal, for the first decade the value of the portfolio is stable. But after about 2000, inflation starts to eat away at our pot, as we need ever larger amounts of money to pay our bills. And after the 30-year period ends, we just about reach zero. Now, this chart on Portfolio Charts looks very complicated, but in fact it's really elegant. First of all, you enter your retirement length, which is 30 years in this case, and this SWR number is the safe withdrawal rate, which looks at the worst 30-year period since 1970 and sets the safe withdrawal rate such that your money exactly runs out at the end of the 30-year period. So in the case of the Golden Butterfly, you can start off by withdrawing 6.4% of your investment pot. And then each year after that, you'd increase the withdrawal by the rate of inflation. Now, the safe withdrawal rate is considerably lower for the Pinwheel portfolio at just 5.8%. And if when you pass away you do want to leave some money for your family, you may be interested in the perpetual withdrawal rate. In other words, the size of your pot remains constant. And for the Golden Butterfly, that's 5.3%, whereas for the Pinwheel portfolio, that's considerably lower. It's 4.7%. And so looking at the withdrawal rates, both the safe withdrawal rate and the perpetual withdrawal rate, the Golden Butterfly, based on historic returns, certainly looks better. So on balance, I think I probably prefer the Golden Butterfly to the Pinwheel portfolio because the safe withdrawal rate is higher and the Ulcer index was lower. Nobody wants too much risk in their portfolio and nobody wants ulcers. Now, I wasn't just trying to show you those two portfolios in this video, but how to use portfoliocharts.com, which is an excellent website to compare other portfolios. They have lots of other stock portfolios there, but you can also create your own based on their returns. And you can adjust it for your country's currency, which is great. If you enjoyed that video and you want to support us, then why not join our online community? You get access to all sorts of goodies, such as our online chat application Slack, where you can ask questions of me or any other members of the community. And you get to join our Sunday evening live call, where you get to ask questions of me and I answer them live as best I can. And you get access to a growing video library, which is only available to Patreon supporters. And alongside those videos, you also get notes, which allow you to follow the links and research topics in more detail for yourself. So if you do want to support us and get access to all those goodies, just click on the icon for Patreon on the far side of this page. And as always, thank you for listening.